He's going to explain he's the director of venture debt at Eastwood Capital Partners, so it's going to be interesting to hear about venture debt.
Well, hi, Tim.
Hi, guys.
You want to tell us about Eastwood Capital Partners?
Yeah, so Eastwood Capital Partners is a venture debt firm, and what we do is we make high-risk loans to rapidly growing venture capital-backed startups. When a startup is growing very rapidly, they often will take in venture capital, and may go to a bank to borrow against their accounts receivable. But there's often a gap that is needed in addition to that, and that's what we do. We provide typically 3-year growth capital loans to emerging growth companies. And we take equity positions in the form of warrants in those companies to give us some upside.
And how long have you been in business?
Eastwood has been in business since 1995. We've financed over 120 companies at this point. We've closed 7 new transactions in the last month. We have another 2 in the pipeline in the next week or so.
Does that mean it's a busy time right now?
It is an exceptionally busy time in the venture debt space. This is an industry that didn't exist in 1990.
Right. It sounded new as you described it. This whole venture debt for companies. Are they pre-IPO companies?
They're typically companies that have 5 to 50 million in revenue, are doubling year after year. It's an interesting space to be in because when I drive to work in the morning, I listen to unemployment reports and troubled situations in Europe and in Greece.
Mr. Exciting.
And then when I get into the office, I deal with companies that are having trouble recruiting. The worst company in the portfolio today is flat. Most of them are doubling year over year, and they're having trouble recruiting technical engineers. So it's an odd tale of 2 economies in a sense.
Wow, that's interesting. Without mentioning names, can you give us a sort of case study to give us a sample of somebody who's growing and what they did, how you help them?
Yeah. So this is a New Hampshire-based company that is a software business. They were doing about $40 million in revenue, and they had gotten there by raising just $2.5 million of angel capital. So a lot of customer financing, working your way up and creating a business. They had borrowed as much as they possibly could from Silicon Valley Bank, which is the market leader in technology lending.
Definitely.
And they needed another $4 million to get them to profitability. They'd engaged an investment bank to raise a $25 million equity round, but equity takes a fair bit of time to put together. There's a long diligence process. And so we lent them the money, we took an equity position in the company and rights to invest in future equity rounds of the business. And as a result, the company's in a much stronger negotiating position when they're negotiating with VCs to inject capital into the business. You can imagine that the CEO and CFO's blood pressure goes up as their cash position goes down. And so in this case, they were able to say, we've got plenty of cash in the bank. It gave them more negotiating leverage with the VCs.